Cryptocurrencies and meme stocks like AMC and GME have a common thread. Their rise in value was unrelated to the actual performance of the underlying asset. That is to say that the value went up because the next chump in line was willing to pay more for it than the last. This becomes very dangerous when this value rising is detached from any physical company or asset actually performing well. Eventually, this house of cards will come crashing down. And it did. The biggest cryptocurrencies are down an average of 60% since January. Investors, especially new ones, need to be wary of a few red flags so they don't get caught up and burned in these traps. A big problem here was that there was little to no fundamental value attached to the business or assets, and it really ran on hype. The media took hold of it and kept telling stories of normal people making crazy amounts of money investing in these things. The more people heard about it, the more random, unsophisticated investors bought in, which drove prices up. Everyone is talking about the next big thing, and even your cousin Ryan is telling you that you have to buy this thing. It's probably too late. Regulatory environment for cryptocurrencies and exchanges is flaky at best. A number of regulators seem to be working on creating frameworks to govern cryptos, but the whole selling point of cryptos is decentralization, which makes regulation very difficult. This in some ways can be positive, but as we've seen with the FTX collapse, it's a huge problem. But I will say that the lack of regulation enables bad actors to take advantage of people. Buying what you don't understand. This is probably the #1 mistake I see new investors make. If I ask you why you bought a certain asset and your answer is because Jimmy said it was good, then you know what? You better sit down and rethink your investment. You need to have a good understanding of how this thing you're investing in is going to reasonably appreciate in value. If your sole thesis is that somebody else will pay more for it than you did, that's not investing, that's gambling. If you truly believe in an asset, and I'm happy for you, maybe it's a good investment, but if you have such strong convictions, you better have done your research. You work hard for your money, and if you're gonna bet on something, why wouldn't you put the time into learning as much about it? Rome wasn't built in one day. The easy road is a lie. It doesn't exist, so stop trying to get rich quick. It's very unlikely, and create a realistic long-term plan and stick to it. And it's been proven time and time again that by being consistent with diversified investments over a long period of time, it's actually likely that you'll end up rich. But very few people actually even attempt to go down that path. You need to stop trading your future for what you want right now. My clients earn 4 to 5 times their investment and grow their wealth over time without market risk, market volatility, and we've been doing this. Put together strategies and design concepts around this. So for more information, book a call.